Welcome.
It's good to be here.
Yeah,
I mean, those are big shoes to fill.
I know, it's a tough panel to follow, but we still got a lot of people in their seats, so that's a good sign. So Brad, quietly or not so quietly, over the past 15 years, you've built one of the best track records in both hedge funds and venture capital. Your hedge fund was up triple digits last year on the back of your time to get fit letter to Meta. And you also fully distributed one of your VC funds, I think at nearly a 50x return. Doing one of these things is already challenging. Doing both, nearly impossible. How do you do it?
Thanks for having me here.
Of course.
Thanks for that introduction.
Of course.
You know, and it's so great to be here to see people who I deeply admire. You know, Bill Gurley, Antonio, Gavin, Peter, and so many others. And we've been at this for a really long time. You know, maybe just a little bit about what makes Altimeter tick.
Sounds good.
I think one of the things that's deeply underappreciated is the passion that we all have fundamentally for what we do. I live in Silicon Valley. My team, we have a very flat team, 26 people, think SEAL Team 6. We're not trying to build some giant asset management firm. We're trying to win championships. And we believe deeply in the power of what we do. I mean, we think that innovation is what moves humanity forward. And so it's not just about earning that next return. But I build an organization that I think allows us to be the best partners to the world's most iconic founders. And part of what makes us great partners is also having a foot in the public markets, right? Being able to text Frank Slootman or Jensen at NVIDIA or talk to Mark at Meta to really understand what's going on in these businesses. As Peter just said, you know, the best bets on AI over the course of the last 18 months or 2 years, which we were fortunate to be in, were NVIDIA and Microsoft, Snowflake. It will come to the venture market, but that's what makes us smart there. And so we all live there. Our kids go to school there. You know, those are our people. And so over the course of the last year, you've heard a lot about the industrialization of venture. We had certain gigantic firms that were interlopers that came, and we can do this at scale, and SoftBank this, and SoftBank 2.0, or whatever. The reality, as Bill Gurley said, you know, we're back to where we were. A cottage industry of deeply dedicated professionals that care a lot about what we do. And I think founders understand the difference between those two things.
Absolutely. And he said 26. He's doing all of this with 26 employees, which I think really underscores how impressive it is.
Well, I mean, maybe just a little bit on that. I mean,
yeah.
You know, at Altimeter, we fundamentally think organizational complexity is the enemy of returns. I'm the largest LP in our fund. We don't make a single investment, public or private, where I'm not writing the first check. Okay? So there's nothing like focuses the mind than eating your own cooking, right? And so I have a team. I refer to myself as the chief analyst, right? We're all analysts, right? And I think one of the things that Altimeter has a reputation for is deep research, because that's what allows us to formulate differentiated, high conviction opinions, and it's only that allows us to make investments, you know, that outperform.
Absolutely. Well, to your point, you're very data-driven. You're known for your data and for your charts. We have a pretty broad audience here, some that are on the public side, some on the venture side. I would love it if we could pull up some of the charts and run through them, and you can give us a little bit of a state of, you know, how you're looking at the world. I think it follows nicely from what we heard earlier with Gavin and Bill and Antonio.
I don't know how I became the chart guy, but I do
just
recall.
That good.
I led the Series B in Zillow in 2005, and I remember sitting in a boardroom with Bill Gurley, Greg Maffei, Jay Hogue from TCV, Rich Barton, and I had my computer open, and I was working on my model. And we were launching a sales force at Zillow, and Barton turns and says, "What are you banging on over there?" And I said, oh, I'm working on my model. He's like, what do you mean you have a model? In the venture business, building a model makes you pretty unique. And since I'm a public market guy, you know, some people have described me as a value investor who got lost in Silicon Valley. I grew up, you know, really reading Buffett. And, you know, I grew up in the Midwest. My dad had gone bust as an entrepreneur. And, you know, I wanted to make sense out of the world of business. So I found a fellow Midwesterner, Warren Buffett, just started reading his letters. But if you think about the question I've been getting a lot here and elsewhere is, you know, the public markets just raced up, like, where are we in kind of the public markets? And so I pulled this chart, and this both explains why we were as bullish as we were in 2023 when the rest of the world had listened to Mike Wilson, was bracing for hard landing. You know, he said at the start of 23, the market's going to be down another 20%. And so every hedge fund, long-only fund, was de-risking, taking down their gross after they had just lost a lot of money in 2022. And we had a different opinion on that for a couple reasons. The first is, you know, the market was about 35% below its 10-year average. This is, you know, a group of software companies. So, you know, like the time to get scared was in 21 when you're 152% above the 10-year average, right? I remember going on CNBC on October 21st from the Milken conference in 2021 saying COVID's over, rates are going to normalize, and when it does, the NASDAQ will be down 30% because multiples will just normalize. And that's exactly what happened here, right? And when you look at this long-term average on in charts, 20 years from now, when people look back at this on a long-term chart, they won't even notice what happened. They'll forget that there was a global pandemic. But the reality is the Fed induced everybody to take risk, and so you had this massive multiple expansion in 20 and 21. And when they took that away, when we went from negative interest rates to normalized interest rates, which was bound to happen, the world crashed in 22. And it made it very difficult to be in the business. I would describe it as trying to fly a combat jet fighter because I had to pay attention as to what was going on in Washington as much as what was going on with our businesses. So last year, we had this big move up in the markets, but as you can see here, we're still trading below the 10-year average, right? The same thing happened in 2009 when I launched my business. My first trade was on November 1st, 2008, okay? And in 2009, we were up over 100%. And I remember people saying to me, I thought, oh, all the money would flow in, but no money came in because they said, you must be a massive risk taker. What happened in 2009 is all the people who got crushed in 08 crawled under a rock in 09, right? And then because the market was up so much in 09, they didn't get in 2010 because they thought all the fun's over. Jeremy Grantham called it the top in 2010, right before a 10-year run that the markets had never seen. So, you know, I tend to be a bit contrarian. I don't pay attention to what others are doing. I look at our research and I follow our research. But this is, you know, as I look here today, you know, that's why we moved into the market aggressively. Plus, we knew what was happening at NVIDIA, at Uber, at Microsoft. And that's what this chart shows. So what's in blue here, those were our biggest positions. Those positions represented over 70% of the deployed long capital in our fund last year. Stock selection matters. Concentration matters. When somebody says, oh, I was in NVIDIA last year, say how much? Right? A 1% position in NVIDIA didn't do a lot for you. But a 15% position in a stock that doubles or triples does a lot. And so, you know, there was a lot of dispersion last year. It wasn't just that all tech went up, right? It's that you had to pick the right tech and then you had to be there in size. And you also have to build a brand that's been around long enough that you can respectfully say some things that matter. You know, Bill Gurley and I, who's been a friend for 20 years, we talked in the fall of 21 about the madness that was going on in the world. And I was worried that we were a part of it, that we had a responsibility to look ourselves in the mirrors. What had we done to get unfit, right? What was happening in the world induced by negative interest rates? And so when I wrote this letter to Mark Zuckerberg, I went on CNBC, and Mark knew this, and I had been talking with Meta for months and months about this, and he's one of the great leaders of our time, deeply underappreciated, I think, as well. But I described it as an open letter to all of us, that all of us had gotten unfit during COVID. Working from home, excess hiring, a loss of focus, and I told him, you can lead the way because, people respect you and you have the ability with supermajority voting control and founder authority to turn the boat 90 degrees. When you say turn left, it turns left. There are a lot of organizations, Google included, that have gotten so complex it's actually hard to turn the boat. And so, on the left side, I had brilliant investors call me up telling me what a fool I was because these were the headlines. It's official. Meta's a disaster. Meta's the worst, this and that. But we did our work, we believed, and we put our money behind it. And that was the result in 2023. And so you look at that and you say, that must mean that 2024 is a disaster. It did that just to get back to where it was before the crash. So when you look at a long-term chart of Meta, you're going to say, it's at 350, it went to 90, and it went back to 350, right? And it's a radically better company today than it was when it was at 350 the first time, earning far more money, and you're going to see that margin expansion continue. I couldn't have been more proud when he wrote what was a seminal letter in January or February of 2023 called The Year of Efficiency, right? And I would encourage you all to read it. I've encouraged all of our founders and other CEOs to read it. But he believed, right? And he said, flatter is faster, leaner is better. And that's why the margin expansion will continue at companies like Meta.
So, why now? Why invest now in the public when you see this run up?
Right. Our return to target in our public portfolio at the start of last year was about 90%. And our LPs, we did our LP update at the start of last year, and it's hard for them to believe it, but that was the underwriting, right? That's how mispriced the world had become. Meta was trading at 6 times fully taxed earnings, right? And so unless you were doing the work and building the conviction, then you don't get there. And it has this huge run up. But the truth of the matter is, as I showed, it just got back to where it was before. We're still trading below the 10-year average. The single worst question, or the question that's cost the most money in the history of technology investing is why now? Okay? Apple went from $3 to 160, and you could have said, why now at every step? It just doubled from 3 to 6. It just doubled from 6 to 12. It just doubled from 12 to 24. I was an investor in Priceline from $40 a share to $2,000 a share. And the number of times I had investors ask me, why now, right? The reality is in technology, it out-compounds because it out-earns. The blue line, the dotted blue line, is the rate at which earnings have compounded over the last 10 years for technology, 13%. And it's compounded their share prices at 17%. Non-tech has compounded earnings at 6% and share prices at 8%, right? Technology as a percentage of global GDP has gone from 5% to 13%. So now I ask you all, in 10 years from now, is technology going to be a larger percentage or a smaller percentage of global GDP? Do you think this trend continues? Do you think technology will continue to out-earn, right? X-tech. In a world where it's getting more efficient, where AI is going to further turbocharge that efficiency. So for me, growing up a poor kid in Indiana, reading Buffett, it was a snowball. Start with a really snowball and a really long hill and compound. And I thought, what better place to compound? I think the biggest cheat in all of investing is investing in technology for the next 2 decades. It will out-compound non-tech. I believed in it so much that I saw this on Twitter the other day. My original chief of staff tweeted this. He said, just found my old Altimeter Capital business cards, which had a compound interest table on the back, which I forgot. So there aren't a lot of people in technology who think about the art of compounding. But I think that's why you have to have an allocation to technology. And then the question is, can I find a partner, a manager, who can help me find the best of tech and avoid the rest?
Right. I mean, it seems like public, it started to bounce back, but VC seems to be tracking a lot slower. Why don't we switch over to venture and share what you're seeing in the state of the venture side of things?
So, you know, in venture, you always have to be in the market, right? I mean, I have, every day in Silicon Valley, we have fascinating entrepreneurs who found product market fit in software, in internet, in AI, in space, in electrification. So that never stops. Top of market, we're meeting with these folks. Bottom of market, we're meeting with these folks. But as Bill Gurley said, it's a cyclical business, right? There are booms and busts in venture, which is why we distributed over $6 billion of profits in 2021, more money than we had ever raised for all of our funds combined, because you got to recognize the periods of excess, right? And so this chart just shows that venture funding is way down. Pulled together my team, you know, Series Seed and Series A on the left, Series B, C, D, and E on the right. The next chart, just according to Carta, the number of VC shutdowns, right? It's accelerating because it's a cyclical business. This is a sign of health, okay? We have a backlog of unicorns that were mispriced in 20 and 21. We had delayed reaction. The public market reprices overnight, okay? Because there are police officers in the public market called short sellers, and they will short a stock until it reaches fair value, okay? That doesn't exist in the world of venture. So I've said on Twitter, delusion is not a strategy, right? Deluding yourself to believe your company is worth 15 billion when it's really worth $1 billion is a bad strategy. So we have this reset in pricing, which is now starting to occur. Klarna repriced from 56 billion to 6 billion. Instacart went public, 39 billion its last private round, now trading at 6 billion. Go through the list. That's all part of the healthy backlog that we'll work through over the course of 24 and 25. It's a tough funding environment. It's tough to raise money from LPs, which means it's tough for GPs to deploy, which means a lot of these companies who in other situations might be able to raise capital are not going to be able to. This is part of the culture of Altimeter, hard truths. One of the things that really drove me crazy during 20 and 21 was this idea of founder-friendly. Founder-friendly in a world of, you know, SoftBank became just tell the founders whatever they want to hear, pay whatever price you want to pay, right? We believe truth-telling is founder-friendly, right? I'm a 4-time founder. I wanted my board to tell me the truth. I didn't want them to have a different conversation outside the boardroom than they had inside the boardroom. So when I wrote the letter Time to Get Fit to Mark, it wasn't because I was trying to take a dig at Facebook, but I was an owner, a shareholder, a partner, and I think that truth-telling is what every founder deserves. Lots of talk about getting fit, but too few boards and founders are having the honest conversations. The honest conversations are starting. Think about the 5 stages of grief, right? Venture capitalists and founders were in 22 in denial, right? They started 23 still in denial and then moved to anger, right? We're just now getting to acceptance, right? And acceptance means like we were all part of this condition. We should celebrate the fact that we survived a global pandemic. And the global pandemic required our government to do things that led to distortions in markets, right? But that's okay. I remember, again, I got Bob Pittman sitting here in the front row, who's been one of my best buddies for 20 years and was, you know, seeded me to put me in business, okay, when nobody else would. And March 26, 2020, 2020, the market bottomed, pandemic. I went on CNBC for an hour, and I said, we've gone all in. The Fed's all in, Congress is all in, I'm all in. I believe in America. I don't know if this is going to take 3 weeks, 3 months, or 3 years, but we'll get to the other side of COVID. One of my LPs heard that interview, a large endowment, and called me up and said, would you take $250 million, set up a recovery fund? I believe in that view, and we want to multiply our money on the back of that view. We set up a 3-year vehicle, and in a year, we more than 2x'd our money, almost 3x'd our money. I distributed the capital back out on the back of that recovery fund. Those are the type of partners that Altimeter's looking for, to have the courage and the sense when everybody else is panicking, to step into the fray. So this is just more on the valuations, correcting that we were talking about.
Right. I want to circle back to compounding and this theory. We've talked a lot about compounding as it relates to thinking about tech, but more broadly, there's a project that you're passionate about that directly relates to this. And it's one of those things, Brad and I were talking about it yesterday, it's one of those things where you say, oh, it's so simple, why didn't I think of that? And I think that's part of the challenge too, is that when you have things that it's like, it's so simple, why didn't I think of that? You kind of move on, you forget. And this is a story that absolutely should be heard. So Brad, why don't you tell us a bit more about Invest America?
So maybe a little context. I started my career, I returned from Oxford. I went to work for an incredible statesman, U.S. Senator from the state of Indiana, Dick Lugar, who had partnered with Sam Nunn to denuclearize the United States and Soviet Union stockpiles as the wall came down in 1991. And working with him, watching his dedication to making the world a better place, that's what, I left after 6 months, and I said, that's what I want to dedicate my life to. He then appointed me Deputy Secretary of State in Indiana. I thought I'd run for governor. But I grew up poor. And, lack of money caused a lot of strife in my household, and I didn't want to spend my life begging people for money. So I was like, I'll go back to business school, I'll make $1 million, and then I'll come back and run for governor.
Good plan.
Well, I never made it back to Indiana, although I love Indiana. So I've spent a lot of time thinking about how do I leverage this platform to tackle the at-scale problems that we're all facing. And we talked a lot about progress. I believe fundamentally, if you look at a chart of global GDP, I wish I had put that chart in here. Bill Gurley and I showed it on the pod last week. Up until the year 1800, the year 0 to 1800, there was almost zero increase, right, in human prosperity. Almost zero GDP. Adam Smith, Wealth of Nations, 1780. Okay? Starting then, global GDP started growing, and human prosperity started growing. Because what is GDP at the end of the day? It's the amount of goods and services we can produce with a fixed amount of labor, the people in this room, and a fixed amount of capital. Pre-1800, it was the equivalent of hunter-gatherer. We were surviving, okay? But because of innovation, the idea of risk-taking, the heroes of this journey are entrepreneurs who move us all forward. And so they lead to this surplus. But the problem of that human progress that we've seen, global GDP was doubling at the rate of every 3,000 years pre-1800. The period of time between 1800 and 1900, it was doubling every 100 years. Global GDP is now doubling every 20 years. But the prosperity is not distributed equally, right? And that's why we see the frustration we see in the world, right? The populist movements. People want to burn it down. According to Pew and Gallup, less than half of people under the age of 40 believe in capitalism, okay? That's the existential risk to this incredible experiment we're all on, right? Ray Dalio describes this well. And by the way, born as an outsider, not having much, I know a little bit something like what it feels to not be in the game, to be on the other side. And so I've spent the last 3 years bootstrapping and thinking about an idea that finally has caught pretty tremendous momentum. which is the way in which we ultimately protect free market democracy and capitalism is by getting everybody into the game. So the idea is very simple. There are 3.7 million children born in America every year. They all get a Social Security number. This legislation would cause the Treasury Department to set up 3.7 million private accounts. Those private accounts would be seeded with $1,000 from the federal government. The total cost to the government is $3.7 billion, less than 0.1% of our federal revenue. Just the incremental funding we're talking about in Ukraine would pay for this for 20 years and 75 million kids, nearly every kid, right, in America. And what this would do, so think of this as a 401k from birth. So I've got Uber and United Airlines and Dell and Microsoft saying, oh yeah, we would match that for the children of our employees. Parents, you know, there's this myth in the world that poor parents don't want to save. Guess what? They do. They just don't know what it means to open an investment account and have an S&P 500, investment. So $1,000, invest in the S&P 500. You can't touch it until you're 18. At 18, 20% can come out for a one-time qualified expense, college, home, start a business. The rest compounds until you're 50. Every kid would be able to open up their mobile device and see on the right-hand side. So we talk about financial literacy. You know why it's hard to learn financial literacy? It's kind of like if you have no reason to learn Chinese, but your teacher tells you you have to learn Chinese, difficult to learn it. Well, if you don't own anything, if you've never owned anything, if your parents don't own anything, if you've never heard of the stock market, hard to get excited about it. But instead, in the 7th grade, you open this on your phone, and they say you now have $14,000 in your account. You own a little bit of Amazon. You own a little bit of Apple. You own a little bit of Microsoft. Let's talk about how that got there, right? Let's talk about the compounding that led to that number. So in 7th grade, they're going to have 14,000. At the age of 30, they would have 175,000. At the age of 55, everybody has $1 million based upon the compounding that's occurred for the last 75 years in the S&P 500. And I am beyond thrilled to say, we've set up a 501c3 and C4. We have bipartisan members of Congress now in the Senate and the House who are deeply enthusiastic about this. From the Clintons to the Kochs, we have excitement about this. We're building a huge bipartisan tent because this is about the future of America. And everybody can agree. This is not the government. This is not a big entitlement program. This is harnessing the power of our economy and letting everybody share in the upside of America. And we expect to have legislation drafted by April or May of this year. We have, I met with, and this is an open source project. Like anybody can take and run with this. I've met with most of the presidential candidates. You know, Dean Phillips called me from New Hampshire. He said, I love this idea so much. I'm talking about it on the stump, and everybody's going wild. He renamed it, American Dream Accounts. And I said, Dean, I don't care what you call it. So long as we get an investment account for every child in this country, I don't care if it's Democrat, Republican, it's going to take all of us. But this is the best investment we can make to keep this incredible experiment going, which is the best experiment that's ever been run in the history of humanity. And the Supercycle we're entering now, you heard it from Gavin, you heard it from Antonio, you heard it from Peter. What's happening in the age of AI will dwarf the internet itself. But you have to hold a couple simultaneous truths. It is true that it will be bigger than the internet itself. Just like in 1998, we knew the internet was going to be huge, okay? But a lot of things went to zero, right? So at Altimeter, we're doing our research, we're doing our studying, we're back in market, but we're not wildly spraying and praying in AI. Because if this is as big as the journey we all know we're on, this is going to play out over decades, not over minutes, right? So if it looks too good to be true, it's too good to be true. Let's not run back into the excess of 2020 and 2021. But I do think that this is going to accelerate the innovation that's going to move all of humanity forward. I couldn't be more excited to be part of it, and we're incredibly fortunate to have amazing partners, many of whom are in this room, foundations, endowments, hospitals, families, that they in their own right do incredible good. Innovation is good for the world. The work they're doing is good for the world. And when we pass this legislation for Invest America, it'll allow every kid to share in the same upside that we all are fortunate enough to share in. So thank you for letting me
Of course. Thank
pound
you
the
so much.
table.
There were lots of phones out scanning
Good.
the QR code.
Good.
So
Let's
that's
get
good to see it.
It's not a moment, it's a movement. Let's make it happen.
Brad, thank you so much. Everyone should absolutely listen to the new podcast that you're doing with Bill Gurley. It's amazing. There's plenty more to hear. And everyone give it up for Brad.
Thank you.